Good morning and welcome to the first lecture of BIAF1005 Financial Accounting. The topic for today's lecture is Introduction to Accounting. Since accounting is largely associated to business activities, therefore, in order to better understand the topic, students should be equipped with the knowledge of business and the purpose for undertaking business activities. With an intent to develop comprehensive knowledge and understanding about accounting, the lecture will cover the following aspects. We will be covering concept and definition of accounting. Nature of accounting will also be covered. History for emergence of accounting will also be covered. We are also going to talk about scope or various branches of accounting. Advantages and limitations of accounting will also be discussed, and conclusions will be drawn for overall summary of the topic. When a person starts a business, whether large or small, his main aim is to earn profit. He receives money from certain sources like sale of goods, interest on bank deposits, etc. He has to spend money on certain items like purchases of goods, payment of salaries, rent, etc. These activities take place during the normal course of his business. He would naturally be anxious at the end of the year to know the progress of his business. Business transactions are numerous that it is not possible to recall his memory as to how much money he has earned and spent. At the same time, if he had noted down his incomes and expenditures from time to time, he can readily get the required information. Hence, it becomes important for a businessman to record details of the business transactions in a clear and systematic manner to get answers easily and accurately for the following questions at any time he likes. What has happened to his investments? What is the result of the business transactions? What has been the earnings and expenses of the business? How much amount is receivable from customers to whom goods have been sold on credit? Businessmen will also be interested in finding answers to some more questions like how much amount is payable to creditors or suppliers on account of credit purchases. What are the nature and value of assets possessed by the business concern? What are the nature and value of liabilities of the business concern? These and several other questions are answered with the help of. Usually, accounting is understood as a language of business. However, a business may have a lot of aspects which may or may not be of financial nature. As such, a better way to understand accounting could be to call it the language of financial decisions. The better the understanding of the language, the better is the management of financial aspects of living. Many aspects of our lives are based on accounting: personal financial planning, investments, income tax, loans, etc. Accounting is used by business entities for keeping record of their monetary or financial transactions. A businessman who invested money in his business would like to know whether his business is making profit or is incurring a loss, the position of his assets and liabilities, and whether his capital in the business has increased or decreased during a particular period. One of the most profoundly used definition of accounting has been given by American Institute of Certified Public Accountants. As such, accounting is the art of recording, classifying, and summarizing in significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. To put it in simple terms, accounting can be defined as the process wherein business transactions having financial nature are recorded in specified books, classified into groups on certain basis, and thereafter the results are derived, interpreted, and communicated in terms of financial performance and position of the business to varied users. From the concept and definition of accounting, we can bring out following as attributes of accounting. Accounting is classified as an art as it helps us in attaining our aim of ascertaining the financial results, that is, operating profit and financial position through analysis and interpretation of financial data, which requires specialized knowledge, experience, and judgment. Another major characteristic is that accounting involves recording, classifying, and summarizing. Recording means systematically writing down the transactions and events in account books soon after their occurrence. Classifying is the process of grouping transactions or entries of the same type at one place. This is done by opening accounts in a book called ledger. Summarizing involves the preparation of reports and statements from the classified data, understandable and useful to management and other interested parties. This involves preparation of final accounts, namely profit and loss account and balance sheet. Another major characteristic includes that accounting records only those transactions which are in terms of money. All transactions are recorded in terms of common measurement, that is money, which increases the understanding of the state of affairs of the business. Now, since all transactions which can be measured in money are considered, therefore, there is no scope for transactions which cannot be calculated or measured in terms of money within accounting. And as such, if an event has no financial characteristic, then it will not be measured in terms of money and thus will not be recorded in accounting. Accounting is also considered as an art of interpreting the results of operations in order to determine the financial position of the enterprise as well as the progress which the business has made and how well it is getting along. It is assumed that accounting has been in existence in one or the other way, since the existence of money. Thus, it is said that accounting is as old as money itself. Since in early age, commercial activities were based on barter system, therefore, record keeping was not a necessity. However, the Industrial Revolution of the 19th century, along with rapid rise in population, paved way for the development of commercial activities, mass production, and credit terms. Thus, recording of business transactions has become an important feature. A description of proper keeping of accounts is also found in Arthashastra written by Kautilya. However, it has been developed with the passage of time to meet the requirements and challenges of ever growing society. The modern day accounting concept based on double entry system was originated by Luca Pacioli in Italy. Increased scale of business operations has made the management function more complex. This has given rise to various specialized branches of accounting. The financial literature classifies accounting into three broader branches, which includes financial accounting, cost accounting, and management accounting. Financial accounting is concerned with recording of business transactions in the books of accounts in such a way that operating result of a particular period and financial position on a particular date can be known. Financial accounting deals with the preparation of financial statements for the basic purpose of providing information to various interested groups like creditors, banks, shareholders, financial institutions, government, consumers, etc. Financial statements, that is, the income statement and the balance sheet, indicate the way in which the activities of the business have been conducted during a given period of time. Financial accounting is charged with the primary responsibility of external reporting. The users of information generated by financial accounting, like bankers, financial institutions, regulatory authorities, government, etc., want the accounting information to be consistent so as to facilitate comparisons. Therefore, financial accounting is based on certain concepts and conventions, which includes separate business entity concept, going concern concept, money measurement concept, cost concept, dual aspect concept, accounting period concept, matching concept, realization concept, and some conventions like convention of conservatism, convention of disclosure, conversion of consistency, and etc. The significance of financial accounting lies in the fact that it aids the management in directing and controlling the activities of the firm and to frame relevant managerial policies related to areas like production, sales, financing, etc. However, financial accounting suffers from certain limitations, which includes consolidated information. That simply means that the information provided by financial accounting is consolidated in nature That is, it does not indicate a breakup for different departments, processes, products, and jobs. As such, it becomes difficult to evaluate the performance of different subunits of the organization. Another major disadvantage of financial accounting is that it doesn't help in knowing the cost behavior, and also it does not distinguish between fixed costs and variable costs. Another major disadvantage is that the information provided by financial accounting is historical in nature, and as such, the predictability of such information is very limited. Cost accounting makes elaborate cost records regarding various products, operations, and functions. It is the process of determining and accumulating the cost of a particular product or activity. Any product, function, job, or process for which costs are determined and accumulated are called cost centers. It relates to collection, classification, and ascertainment of the cost of production or job undertaken by the firm. The basic purpose of cost accounting is to provide a detailed breakup of cost of different departments, processes, jobs, products, sales territories, etc., so that effective cost control can be exercised. Cost accounting also helps in making revenue decisions such as those related to pricing, product mix, profit volume decisions, expansion of business, replacement decisions, etc. The objectives of cost accounting, therefore, can be summarized in the form of three important statements, that is, to determine costs, to facilitate planning and control of business activities, and to supply information for short and long term decisions. Cost accounting has certain distinct advantages over financial accounting. Some of these advantages includes the cost accounting system provides data about profitable and non-profitable products and activities, thus prompting corrective measures. It is easier to segregate and analyze individual cost items under cost accounting and to minimize losses and wastages arising from the manufacturing process. Production methods can be varied so as to minimize costs and increase profits. Cost accounting helps in making realistic pricing decisions in times of low demand, competitive conditions, technological changes, etc. Another major advantage of cost accounting over financial accounting is in case of number of alternative courses of action. Now, when various alternative courses of action is available, then under cost accounting, these alternatives can be properly evaluated with the help of data generated by cost accounting. It would not be an exaggeration if it is said that a cost accounting system ensures maximum utilization of physical and human resources. It checks frauds and manipulations and directs the employer and employees towards achieving the organizational goals. Management accounting relates to the use of data collected with the help of financial accounting, and cost accounting for the purpose of policy formulation, planning, control, and decision making by the management. The management of a company has to solve certain questions like expansion of business, make or buy a component, adding or deleting a product line, decision on alternative methods of production, etc. The financial accounting information is of little help in answering these questions. Management accounting, thus, is tailor-made accounting. It facilitates the management by providing accounting information in such a way so that it is conducive for policy makers and running the day-to-day operations of the business. Its basic purpose is to communicate the facts according to the specific needs of decision makers by presenting the information in a systematic and meaningful manner. Management accounting, therefore, specifically helps in planning and control. It helps in setting standards, and in case of variances between planned and actual performances, it helps in deciding the corrective actions. An important characteristic of management accounting is that it is forward-looking. Its basic focus is on future activity to be performed and not on what has already happened in the past. Since management accounting caters to the specific decision needs, it does not rest upon any well-defined and set principles. The reports generated by management accountant can be of any duration, be it short term or long term, depending upon the purpose. Further, the reports can be prepared for the organization as a whole as well as of its specific segments. Accounting provides number of advantages to the businesses. As such, all financial transactions are recorded in a systematic manner in the books of accounts so that there is no need to depend upon one's memory. It is impossible to remember the business transactions which keeps on growing in size and complexity with the passage of time. Another major advantage is that because of proper recording of transactions, preparation of financial statements is facilitated, which includes your trading account, profit and loss account, and balance sheet. Another major advantage includes that accounting information, when properly recorded, can be used to compare the results of one year with those of earlier years so that any significant change can be analyzed. Also, accounting information helps the management to plan its future activities by preparing budgets and coordination of various activities in different departments. Also, properly recorded accounting information can be produced as evidence in the court of law as and when needed. Interested parties like owners, creditors, management, employees, customers, government, etc. can get financial information about the organization with the help of accounting. Income tax and sales tax authorities also depend on the accounts maintained by the business concerns for taxation purposes. Also, when the business is to be sold, the accounting information can be utilized to determine the proper value of business so that sale of business can be done at a reasonable cost. Though accounting provides a number of advantages to the business concerns, there are certain limitations to accounting as well. As such, the accounting information is expressed in terms of money. Herein, the accountant measures only those events that are of financial nature, that is, capable of being expressed in terms of money. Any non-monetary item or events are not measured and recorded in accounting. Accounting information is based on estimates. Some accounting data are based on estimates, and estimates may be inaccurate. Therefore, the results derived from these estimates can be inaccurate as well. Accounting information may be biased. Accounting information as such is not without personal influence or bias of the accountant. In measuring income, accountant applies a choice between different methods of inventory valuation, depreciation methods, treatment of capital and revenue items, etc. Hence, due to lack of objectivity, income arrived at may or may not be correct in certain cases. Fixed assets are recorded at the original cost. The value may of fixed assets change over from time to time, so there may be a great difference between the original cost and current replacement cost. Balance sheet may not show true and fair view of the financial position on a particular date because fixed assets are recorded at its original cost in accounting. Accounting can be manipulated. Any accounting information may not be used as the only test of managerial performance, as profits can be manipulated or misrepresented. Money as a measurement unit changes in value. That simply means that the value of the money does not remain stable unless price level changes are considered in measurement of income. The accounting information will not show true financial results. To conclude, accounting can be said as the language of financial decisions. It is an ongoing process of measuring performance and reporting the results to decision makers. The discipline of accounting can be traced back to very early times of human civilization. With the advancement of industry, modern day accounting has become more formalized and structured. Depending upon purpose and method, accounting can be broadly classified into three categories: financial accounting, cost accounting, and management accounting. Financial accounting is primarily concerned with the preparation of financial statements, mainly for outsiders. It is based on certain well-defined concepts and conventions and helps in framing broad financial policies for the business concerns. However, it suffers from certain limitations which are taken care of by the other branch of accounting, viz. the cost accounting and the management accounting. Cost accounting emphasizes or cost determination, aiding the planning and control process and supplying information for short and long term decisions. On the other hand, management accounting is meant to help in decision making by analyzing and interpreting the information generated by financial accounting. As such, management accounting is futuristic and decision oriented. The method of management accounting are not very exact as they have to be varied according to the requirements of the decision. The basic difference between financial and management accounting arises due to differences in users of information, differences in time frame, and type of reports generated. The criteria for decision making and the behavior implications of both types of accounting are also different. Herein are some of the references which students can use for creating better and more clear understanding about accounting and its different concepts. Thank you and have a great